Today we're looking at an analysis on ClearMind Medicine, which makes the case that at 11 cents, the stock is a mathematical steal because its cash position is so much higher than its market cap.
It's a really compelling setup. I mean, the arbitrage is right there in black and white, a classic value play. But I think the analysis needs to push beyond just the math to really land the argument.
Right, because the hook is that free money thesis. The report does a great job laying out the negative enterprise value. You buy the company for what, $2.3 to $2.7 million?
And you immediately own $3.5 million in cash.
Exactly. So you're effectively getting paid over $1 million to take the whole patent portfolio and the clinical pipeline.
And that's a fantastic frame. But I wonder if presenting that pipeline as just a freebie actually weakens the long-term case.
That's the perfect place to start. Our first point of feedback is all about angle and originality. The shock value is high, but the long-term justification could be stronger.
The analysis relies almost exclusively on the short-term financial arbitrage, but the presentation of the pipeline catalysts could be better integrated to establish a non-zero, justifiable long-term valuation floor.
So the weakness is that it points out you get the pipeline for free.
Right, which is ironic and catchy. But it stops there. It doesn't provide even a basic, qualitative framework for what that pipeline is actually worth. It just lists the wins. You know, the positive phase 3A data for alcohol use disorder, the safety confirmation, getting sites like Johns Hopkins and Yale online.
But it doesn't translate those milestones into any kind of tangible value.
None. And in microcap biotech, if you say something is free, the immediate assumption is that it's worthless junk, no matter how much cash is on the balance sheet.
Okay, so it leaves the core assets looking like a speculative lottery ticket instead of a foundational part of the value.
Exactly. You need to shift that perception from free asset to undervalued asset with a floor.
Which leads us straight to the suggestion.
The suggestion is to bolster the argument by briefly quantifying the potential value of those clinical assets. That anchors the thesis in both the short-term cash mechanics and the long-term asset worth.
You're saying it preempts the skeptical argument that the pipeline is junk.
It completely neutralizes it, because you're putting a number, even a very conservative one, next to the value proposition.
But what if it's hard to find direct comps? I mean, phase 3A assets in the AUD space, that's a pretty niche area. What if those deals aren't public?
That's a fair point. It doesn't have to be a full-blown financial model. It just needs some external context.
So give us a concrete example. What could the report actually do?
Well, instead of just listing the trial success, it could introduce a quick comparative analysis. For instance, reference the typical valuation for similar microcap biotech assets at this stage in this therapeutic area.
Okay.
Even if you can only find one or two recent licensing deals or a peer company that was acquired. Just citing industry norms for de-risked assets at this stage would show the mispricing goes way beyond just the cash calculation.
So if a comparable asset usually fetches, say, $5 or $10 million in enterprise value,
then owning this one for -$1 million is just a completely different level of mispricing. It shows you've done the homework on the science side, not just the balance sheet. It turns a simple trade into a deep value argument.
that definitely adds a lot of muscle to the narrative.
Agreed, and that actually brings us to the next big thing everyone is watching with CMND, which is the cash burn, the ticking clock.
Right. The report correctly flags this. About $1.3 million a quarter, which gives them maybe 6 to 9 months of runway before they need more cash. Huge pressure to get news out.
And this is where we get into the completeness and focus of the risk assessment. The discussion is there, it's accurate, but it doesn't really game out the strategic implications of that timeline.
How so?
The discussion of the cash burn risk is accurate, but the analysis could be strengthened by more systematically framing the 6 to 9 month runway as a probability window for success rather than a fixed timeline for failure.
Ah, okay. The weakness being that it sort of presents dilution from an offering as this static, unavoidable outcome.
Yes, it frames it as a binary choice. Either they get good news out in time, or they're forced to dilute and the stock gets crushed. It's an oversimplification.
Because management has choices. They control the timing, to a degree.
They absolutely do, and the analysis needs to model that. So the suggestion is to present a clearer scenario analysis that maps the timing of known catalysts, like that Phase 2A data, against when they'll likely need to raise cash.
So you're moving from just listing a risk to actually modeling it.
Precisely. You give the reader a calculated risk profile.
That's a big jump in sophistication. So when you talk about modeling scenarios, you're really talking about two different paths management could take, right? Raise early for certainty or wait for a better price.
You got it. And they're terrible choices to have to make. If they need cash by month 6, but the data isn't due until month 8, what do you do? raise now at 11 cents and punish your shareholders? Or do you roll the dice and risk running out of money if the data's delayed?
So the report should lay out what each of those choices looks like financially. Give us the concrete examples of how to structure that.
Okay, so the analysis could model two really clear scenarios. First, the certainty scenario. The report should model what the implied dilution would be and the new post-dilution share price if they do an offering before the Phase 2A news drops.
And that sets the absolute floor. If they need $5 million at the current price, the dilution's going to be huge. The analysis needs to show that hit to the cash per share value.
Absolutely. And then you contrast that with the price maximization scenario. Project what the cash position and the new runway would look like if they raise money after a big positive PR event.
Because if they get good news, they could maybe raise at or above the cash value. That 17 to 20 cent range we talked about. The dilution would be minimal.
The difference between those two is massive. It could be 30% dilution versus 5% dilution. Quantify that. By putting numbers to those two forks in the road, the runway stops being just a simple metric. It becomes a strategic window that you can use to understand the company's next move.
That's a much more powerful way to understand the risk-reward. That's what separates a good analysis from a great one.
And building on that financial clarity, let's talk about the liquidity section. The report does a great job highlighting the strengths. Zero debt, which is rare, and a strong current ratio of about 1.92.
Yeah, it correctly points those out as differentiators, especially in the microcap space where you see so much toxic financing. But maybe there's more to say there. This brings us to our critique on significance and relevance.
While the zero debt status and strong current ratio are correctly highlighted as strengths, the report needs to more sharply define why this specific liquidity profile is rare and how it specifically insulates shareholders from critical microcap pitfalls.
So the weakness is that it identifies the clean balance sheet, but it doesn't fully connect the dots to the operational effect of that cleanness.
Exactly. It says no toxic debt, removes immediate bankruptcy risk, which is true, but it doesn't fully exploit how that zero debt status gives them flexibility when dealing with other threats like the NASDAQ delisting notice or the auditor's going concern warning.
Okay, but isn't having zero debt just, good business? Why is that so important here that it needs this much focus?
Because at this market cap, the average microcap biotech is often funded by convertible notes with really punitive terms. When the stock price falls like this, those debt agreements often have clauses that kick in, forcing management's hand. CMND doesn't have that. They aren't being held hostage by creditors.
Ah, I see. That makes the rarity of it much clearer. So the suggestion is to make that link explicit.
The suggestion is to pivot that section to directly contrast CMND's clean financial structure with the maneuvering room it gives them to handle the big regulatory threats that are already mentioned in the risk assessment.
This is where the zero debt thesis really earns its keep.
It becomes a true competitive advantage.
So give us a concrete example. How should the report phrase this to make it punchier?
Instead of just listing the numbers, it could frame it operationally. Something like, the zero debt position ensures that if CMND has to address the NASDAQ delisting threat with a reverse split or manage the auditor going concern warning, management has total flexibility to act without being constrained by restricted debt covenants or punitive financing terms.
Wow, okay. That's powerful. It directly connects the balance sheet to corporate survival tactics. It argues that they can focus on the science and the strategic financing like we just talked about, instead of fighting with creditors.
It says this company is unique because it has complete financial autonomy to navigate these risks. In a market where corporate finance often kills good science, that autonomy is a premium feature, especially when the enterprise value is negative.
It's a fantastic point. Focusing on that operational impact is a powerful way to frame this as a quality asset in a low-quality valuation bucket.
The analysis report has a great foundation. The math is solid, but these additions will really boost its persuasive power and give a much deeper context.
All right, let's do a quick recap of the actionable suggestions. First, integrate that pipeline valuation into the core thesis to set a real long-term valuation floor. Use some peer comps.
Second, systematically model the dilution risk. Build out those two clear scenarios, raising capital before good news versus raising after. Turn the runway into a strategic decision window.
And finally, define the operational advantage of that zero debt profile. Link it directly to management's flexibility in handling big regulatory risks like delisting or a going concern warning.